That's what I'm looking at. And that's why I don't think the valuation analysis is that value investors want to cram down people's throat is sensible.
Hello, everyone, and welcome to the Investing City podcast, where the goal is to get better at investing, business, and life. Thank you so much for taking the time to join us. It really means a lot. Without further ado, enjoy this episode. On today's show, we interview Bert Hochfeld. Hochfeld graduated from University of Pennsylvania, and then he went on to get his MBA from Harvard. After that, he worked for various tech firms such as IBM, Memorex, Raytheon Data Systems, and BMC Software. Then, later in the 1990s, he started working as a sell-side analyst, and he won multiple awards for the coverage of the software space from Wall Street Journal. Later, he formed his own independent research company and also a couple hedge funds. Bert Hochfeld is one of the best equity researchers in the technology space, and it's our pleasure to interview him on his ideas about how we can become better tech investors. Just so excited to have Bert on the podcast. Bert is a legend in the equity research space, and we're just so honored to have you on, Bert.
Well, that's very kind. I don't know if I'm a legend. And if I'm a legend, I hope I'm a good one. But what can I say?
Okay, so let's just hop right into it. Bert, can you give us a little bit of just your background and how you got interested in the stock market and maybe just kind of your progression into where you are now?
Sure. Well, I'm 72, so that's a bit of a long story, but I've been interested in the stock market for, believe it or not, 60 years or something like that. My parents encouraged my interest, and my father tried to teach me a little bit about the stock market. And I've always been fascinated by how the financial markets work. And I was fortunate enough to go to the University of Pennsylvania, where the practice of econometrics was being developed in the early 1960s. And then I went to HBS. And then I went to work for IBM. And so I had a good background in this area. And I worked after I worked at IBM. I worked at several other tech companies, Raytheon Data Systems, BMC Software, etc. And finally, I decided I wanted to come back to the Northeast. I'd been in Houston, and so I came back up here at 25 years ago and got into the stock analysis business full time. I worked for a variety of companies. I set up my own independent research company when that became the way of doing this business. I set up a hedge fund as well that invested in the tech area. And over time, I decided that I would set up a website subscription service for people that are interested in tech investing, and that's called Ticker Target. And I welcome your listeners to subscribe, but that's where I am today.
So your first job out of HBS was at IBM. Was that kind of a crucial turning point in you becoming really interested in technology, or had you been interested before that?
I'd say I've been interested. I've been interested in technology for a long, long time, and have been interested in working at IBM for a long, long time. And I had that opportunity back in 1969. IBM was gracious enough to hire me after my military service. And so I went to work there as a financial analyst, doing pricing and planning. And I got to understand how the computer industry worked at that time from the perspective of the dominant player. I mean, it's hard to believe today, and it's a sad story, but IBM, as you may or may not be aware, basically was the number one company in the space, and it had the opportunity to remain a dominant player for many years. Sadly, it didn't choose to grasp the nettle, so to speak. It was always an issue with IBM of the level of money they might leave on the table if they innovated too rapidly.
Do you think there's something that they like obviously should have seen, some paradigm shift in tech, or because you read all Clayton Christensen's kind of literature on companies being disrupted, and how do you think they could have prevented that?
Well, I mean, I can, from my own personal experience, IBM simply wasn't prepared to give up current profit dollars to innovate as rapidly as possible. My little area of the business was peripherals, what today people call storage and memory. And IBM had the opportunity to develop that area of their business far, far more aggressively than they did. I mean, IBM basically just gave up market share to EMC and particularly to NetApp because they chose not to engage at the level that they should have. And now, as we are in 2019, IBM does not have its own hyper-converged solution. I mean, they basically have hardware, but they have to get their software from Nutanix. That's a sad commentary, I would say.
And you mentioned Nutanix. It's a company that is really interesting, and I think it would be a cool practice for us to kind of go through that company as kind of like a blueprint for your research process, and just like how you start looking at a company, how. But let's start with how you find companies, sort of like your sourcing.
I Friends of mine in the business have directed me to Nutanix. Oh gosh, about 7 or 8 years ago. So when it went public a couple of years ago, I was focused on what they were doing, and I was focused on how they were doing it. I Hyperconverged is something that people have wanted to be able to deal with for a long time. It's a far more efficient process of how shall I put it, of propagating a data center than having a separate silo for storage, a separate silo for networking, a separate silo for processing. So over the years, people have been looking to figure out how they could combine all those activities in a single package and reduce latency and make it far easier for users to enjoy the benefits of modern technology. I'm not going to try to argue whether Dell, VMware, or Nutanix got there first because it's kind of a sterile debate, but I will say that the man who runs Nutanix, Pandy, is obviously one of the more far-seeing individuals in the world of IT. He's developed a fantastic stack of technology in a very short period of time. And I was able to figure out that Nutanix would have a very bright future because he was fulfilling a need that people have, and that is to do away with very expensive, difficult to manage, difficult to customize data centers. Nobody wants, no normal enterprise wants to be in the data center business. That I can promise you. And with hyperconverged, you have the opportunity to have a self-managed data center that's cheap, very quick to set up, and is basically self-mending. It took off, and the company had a stumble one quarter right after it became a public company, and you had the opportunity for about 6 or 9 months to buy the shares at a reasonable valuation. You still have that opportunity. The stock, in my opinion, is still very cheap, but I focused on Nutanix because they were the leader in a hot area of the IT firmament. They still are. The Z product that finally reached general availability at the end of last year has the opportunity to disrupt the space yet again. It will disrupt the space yet again, in my opinion. It's the first major innovation in backup and recovery that I've seen since the days of data domain, if you remember data domain. And it sounds to me like you're young. You may not remember that, but big deal. This is a very big deal in backup and recovery.
It would be awesome to kind of break down just your research process when you're looking into Nutanix. So your friend brings you the name Nutanix and following it for years and you find out that it IPOs. What are kind of the things? Obviously, you're reading all the statements, and I'm sure you're looking into more of the technological differentiation. But for listeners, like, what would be your advice that they could kind of take actionable steps in order to have like a much more informed investing process?
I would suggest that they try to figure out what the pain points are for users in the IT world. I mean, generally speaking, what you will find is that the highly successful companies are doing things that people have been complaining about for years. That is to say, users have been complaining about for years. You take an example, more recent example, Zscaler. If you're at all familiar with the IT world, you know very well that people have had to populate their data centers with appliances from Palo Alto, from Fortinet, from whoever. It's a pain in the whatever. And it's really not something that anybody wants to get involved with. And the management of trying to coordinate hundreds of different firewalls, because you need a firewall every place that you have data. So Zscaler comes along and offers a service which is particularly attractive if you're morphing to the cloud. And instead of having a hardware box at every data center, it has a facility that ingests all the data and searches for anomalies and protects you in that fashion. The thing about Zscaler is it's way faster. It scales much better. I mean, that's why it's called Zscaler. And it solves the pain problem for people trying to have to migrate to the hybrid cloud. So you don't have to be. I mean, the fact that Zscaler, that the numbers bear that out. The numbers say that Zscaler is growing at 70%. But what you need to do, in my opinion, is to focus on why it's growing at 70%. It's growing at 70% because they can provide a facility that you can't get anywhere else. And that's how I start looking at companies: is how do they make a difference in the IT world? Okay.
If somebody maybe wasn't extremely involved in technology, didn't maybe have a technology background, but is really interested in these sort of companies, how would you advise them to kind of do the research in order to find out those pain points? By just thinking about it kind of commonsensically, or is there kind of a process that you would advise?
Well, there is a strong amount of common sense involved. I mean, not everybody who's started a company in this space is successful, and the ones that are successful have focused on what it is that people have problems with. You take Viva or Guidewire. The people who founded these companies, for example, they Marcus Rue was in the consultant in the insurance industry, I think, for 15 years before he founded Guidewire. Figured out that insurance companies did not properly address how to quote products using IT, and built a solution and built a multi-billion-dollar business. The same with Peter Kastner at Viva. You asked me about process. The first thing I would do is look at who runs these companies and their record. And you can do that so much more easily today by looking at their LinkedIn profile and get a sense of who they are. I think you and I talked about Jeff Green over at Trade Desk, right? Look at Jeff Green's background, okay? If there's somebody who knows about what people want in the online advertising space, is going to be Jeff Green, I can assure you, because he's been there and done that. I mean, this is not his first online advertising company. He sold one of them. He knows the business backwards and forwards. So he figured out that programmatic advertising and connected TV were going to present major opportunities, and built a company around that idea. And I would suggest that your listeners, go to the web. And today, doing research is infinitely easier than it was 10 years ago. Because you can read all kinds of things about connected TV. You can read all kinds of things about programmatic advertising. You can find out what other people think the growth rate is. You can easily get a hold of conference call transcripts. I mean, not everybody, contrary to popular belief, not everybody in corporate management are liars. I mean, a lot of them actually give you good information. So I think your listeners can do a process whereby they become not experts, but at least have some basic knowledge about why companies might be successful. They can start by looking at who runs them and what their track record is, and then they can look carefully at what third parties might say. Now you take a company that I like, it's called ANET. ANET is run by, for sure, two of the highest talents in the networking space. I think Jayshree, her name is hard for me to pronounce, Ulalau, and her colleague, who basically was the technology guy at Sun, know more about networking than the next 10 people combined, really. So it's not terribly surprising that Arista Networks has been able to take market share at a huge rate in the network switching business. It's run by the people who know more about network switching than anybody possibly can.
Management is obviously very important, so big emphasis on management. Are there any other indicators that you're typically looking for? That because a lot of investing is just pattern recognition. So, what are some other of those indicators for yourself?
I'm looking for companies that are enjoying a fair amount of, well, today, let me back up. There are some metrics that most of us use that work well in context. I look at EV to sales relative to growth. That's the I actually have put together a chart, which is kind of my Bible, and a best fit line, and I see where companies fall on that line, whether they fall above or below. So I look at their growth and I look at their EV to sales, and I think that's very important. Okay. So the second thing I look at is I take the same data set with regards to EV to S ratio, and I look at their free cash flow margin. So you take a company like Viva, which you might think, or Atlassian, or Elastic, or some of these other companies, and they look like they're very expensive because, and many, you'll see many commentaries about that. And then you say, are they very expensive? And you look and they have very high free cash flow margins, so they're not, investors are being quite rational. They're paying up for great business models. You probably want to try to evaluate competitors. Nowadays, people can go to the web, they can read Gartner Magic Quadrant analysis. I strongly suggest that people do that at least as a background, or if they prefer IDC, which has what they call a wave analysis. So I look at those, and I try to build a mosaic around those things. I don't mind paying a lot for Elastic because although some people no doubt think I'm crazy, I don't mind paying 12 times but EV forward revenues. A, because it's profitable, and B, because I think how shall I put it? I love the tech. I don't mean to say I love the technology. I love what you can do with the technology, all that it can accomplish for you. And the fact is, nowadays, I look at what's called the dollar based net expansion rate. That's a very crucial metric for me. I want to see if a person uh, spent $1 on a solution in year one, how much he's going to spend in year two and year three. Uh, many companies will report that metric, and I would spend a lot of time focused on just how high that can be. Twilio is a name that you may be familiar with, that your listeners may be familiar with. Why did Twilio more than treble last year? Well, you can say the growth was better than expected. But what I would point out, as much as that, is that the dollar based net expansion rate stayed at 50%. That's remarkable. It really is remarkable. It means that customers were expanding their usage of Twilio 50% a year. That's how you get to be a big company.
And you mentioned in all that good information some valuation stuff. And so the first thing that a lot of people would be skeptical about investing in technology stocks is probably valuation, right? And I'm sure you get that a bunch. So how do you kind of think about valuation? And you mentioned a little bit with Elastic, sort of numbers, you're looking at comps and things like that. But what would you say to somebody who is a hardcore value investor, who wouldn't touch the type of stocks that you or I invest in? What would you kind of say to them?
I had this conversation, interestingly, with a colleague of mine about 10 days ago, and I said 70% growth cures almost anything you need to worry about when it comes to valuation. Elastic happens to be growing at 72 or 73%. So, yeah, valuation in the classic sense, you're not going to find companies that are growing at 70%. Part of the problem, I would say, is that value investors have a difficult time in understanding why it is that a company can grow at 70% for 2, 3, 4, 5 years. Okay. And that's where you got to get involved in understanding what people do with the product. And this is not consumer electronics. This is stuff where people take it and they build it. They use it to create things, and that's hard for uh, some people just don't have the desire to or the imagination or to try to understand what a digital transformation is. They say digital transformation, oh, that's just so much marketing. Well, it's not. Okay. I mean, if you're going to buy auto insurance, how do you want to buy it? You want to get an agent involved who's going to, you've got to make a commission. He's not going to give you the best price. You want to buy it online. You want to be able to compare prices. You want to be able to sign up for it completely online in a self-service paradigm. So you got to be able to figure that stuff out. You can't say, okay, so Guidewire or Pega, which do these kinds of things, they're too expensive. Well, no, they're not. They're not expensive at all, because that's going on right now, and it's going to continue to go on for several years. You want to buy a house? How are you going to get a mortgage? You're going to go to a mortgage broker, or do you want to go online and look at competing rates, terms, conditions, and do it self-service? Some people, if they're older, I suppose they do want to talk to a mortgage broker, but younger people, no, they want to do it a different way. And that's going to continue to go on for a long period of time. I mean, you look at companies like Shopify and Square that have transformed the way people do e-commerce. Their growth is not going to. So you say, well, they're very expensive. Well, they're very expensive if you think their growth is going to come to a halt. If you think they're going to continue to innovate for 5 years or 7 years and have hyper growth for a long period of time, well, they're not expensive at all. They're cheap. And again, I'll get back to management. Jack Dorsey is a genius. Now, I may, not like the clothes he wears or his politics, but he's a genius, okay? He has figured out how to create a solution that small business people find extremely attractive, and has created a business around it. And it's not going to stop growing in 2019 or in 2020. Jack and his colleagues are fantastic innovators. That's what I'm looking at. And that's why I don't think the valuation analysis is that value investors want to cram down people's throats. That's why I don't think is valuation analysis. I mean, maybe that's is bad for me to say. Value investors, I think they're looking to. They're not cram down people's throat. Seriously, is how the world is changing.
Looking at technology, a lot of those same value investors would probably say that the world changes so quickly that how can you kind of stay on top of all of this innovation? And kind of what's your thoughts, or if you have a process on staying up with, because the world does change, especially in the IT landscape. So how do you stay on top of this ever-changing investment landscape?
Well, I mean, these days, it's so much easier than heretofore. There are many services that allow investors to look at preliminary analysis of IPOs. There are more subscription-based services that are free than you can shake a stick at. And you got to read a lot. Okay, I mean, you're gonna read about what you're gonna get on the mailing list or the email distribution list of these companies, and they're gonna send you product announcements, and then you're gonna look at how those product announcements are analyzed by industry experts, because you can find that on the web nowadays. And that's what you're going to do. Now, you're not going to get it right all the time. Jack Dorsey doesn't get it right all the time. Toby Lutke at Shopify doesn't get it right all the time, and so forth and so on. But you look at what they're doing and you evaluate it. And one of the things I suggest people do is think of themselves as users and decide whether or not, if they were buying a solution, that they would buy what was being offered. And sometimes that's hard to do. And I don't say it always works, but I don't know if you remember Peter Lynch and how he ran Magellan, but it's a lot like that. It's a lot like that. And for example, uh, Jack Dorsey put together a set of solutions around the restaurant business, the food service business, that you would have never in a million years thought was something that would be high growth and profit. But if you thought about it from the point of view of the restaurateur who needed to figure out how to deliver food to expand the revenue base and then get paid for it quickly and then keep track of inventory and pay the people in the restaurants. It's all on one seamless platform, and it's proven to be incredibly successful. And people had a lot of skepticism when it was first introduced. And I said to myself, I don't know that much about how to run a restaurant, but solves a lot of problems for restaurants. And it's worked brilliantly. So,
just to kind of go off of that, that is sometimes hard is just figuring out kind of the competitive landscape. Because one of the flaws sometimes that people point out with Square or maybe even Shopify is that there's a lot of alternatives. And maybe somebody says it's a crowded space. So how do you kind of think about that in terms of competition, whereas some other company like Twilio maybe doesn't have competition at the same level of scale? So how do you think about that?
Ryan, they all have competition. Twilio has, if you go to the web today, this afternoon, and you go Twilio competitors, and you'll see Quora or other answers, the G2 Crowd or whatever. They all have competitive alternatives. Believe me, it's a matter of execution, sales and marketing. It's a matter of how aggressive you are. Okay, I mean, obviously, Square and Shopify have been have become the category leaders because they've been willing to be far more aggressive than the other folks in their space. I mean, Mercado, for example, still it's not a hosted product. Okay, that's Shopify. Okay, we're people. You tell me? If you want to create a web store? You want to be in the IT business or you want to be in the selling business? I think you don't want to be in the IT business and self-host and deal with that. So Mercado could have been a big company, but they made that choice, and Shopify became number one in the space. You could figure that out. I mean, I happen to have made that choice for something else that I do. And it's just if you want to create a web store, I guarantee you, you're going to go to the Shopify solution first. If you're an SMB and you need to take payments remotely, Square was there first. It had a first mover advantage. I remember when they were running commercials about golf pros and babysitters and God knows what else. And they got several 100,000 users in short order. And they took that and leveraged it to build a business around it. I mean, payments are payments are payments. If you can take a payment remotely, it's fungible. But Dorsey didn't rest at that level. I mean, I never would have thought that people would pay a point to get their money the same day, but they do. Uh, you figure out what that interest rate turns out to be, and why Square became the behemoth it's become. Okay, uh, it's I I still have to shake my head and say, how the heck did he figure out that there was such a demand for getting paid the same day that you sold something, and that you could charge somebody 1% and they pay it? Very smart man. Very smart man.
Sometimes other investors, maybe more low growth investors, more value investors, talk about technology. They talk about how kind of the sexy industries get bid up in price, and longer term that might not be sustainable. What do you have to say about that?
The reason people pay a lot of money for IT companies is because I don't try to look at macros all that much, but the the percentage of GDP going to IT is rising continuously. It's doing so because of the productivity gains that it's very hard in 2019 to be able to create improvements in productivity any other way. You don't think that these companies that are doing digital transformations are doing it because they enjoy tearing up a business structure that's been in place for 50 or 75 years. It's cheaper to do it that way. I mean, it's far cheaper if you can get your customer to be his own salesman, isn't it? And that's really what's happening. So you're doing away with insurance agents, real estate agents. When's the last time you used a travel agent, Brian? That entire bit. I mean, you're young guys, so you probably never have used a travel agent.
That's
So,
right.
uh, what I'm telling you is all the money that used to get spent travel agents now get spent on building websites for airlines, hotels, etc., etc. That's why people pay a lot. It's pretty straightforward. You can't operate a hotel or an airline or whatever unless you have a good website. You can pay whatever it takes to have a good website, because otherwise you're going to go out of business. And if that costs you more money, it costs you more money, man. I think what you're seeing is that the world is moving that way and will continue to move that way for the foreseeable future. And I think that's why people pay so much money for IT companies, is because they're increasing their share of GDP, because they have a lot of people ask me, they say, Bert, What's different today than 2009 and particularly than 2000? And I say the biggest difference is you don't see vaporware. You see very high tangible ROI, and that's why people pay a lot of money for this stuff.
You touched on a lot of really good points there. And what do you think about kind of barriers to entry? Because typically, maybe in the old world, you had like hard assets where somebody with maybe a lot of money up front could compete with you, but then that would create maybe economies of scale. How do you think about that, and how do you monitor kind of competitive advantage in the IT world?
First of all, you want to recognize that there's always competition. I have yet to see a decent space in which there wasn't competition. So I look at the biggest barrier to entry being the entire process of innovation. And does a company have a culture of innovation? Or does a company, I mean, I'll get back to what we started with IBM. IBM, it was in the paper today or yesterday, has the most patents of any company in the United States. I think it was 9,000 they got granted last year. But they don't really have a culture of innovation. They're not willing to eat their own children. Whereas the successful companies, the ANETs, the Nutanix, the Alteryx, are replacing successful products with the next generation, and the next generation they're willing to spend an inordinate amount of money doing so. And if it keeps their business model not at levels that might have been considered appropriate some time ago, so be it. I'm not an expert on Apple. I absolutely disclaim any domain expertise. But I'll say one thing, and that is that Apple has been unable, for whatever reason, to figure out the next big thing in consumer electronics. And whether it's Mr. Cook or whether it's the culture or what it is, a strategy of raising prices is exactly opposite what you see in the technology space, where prices come down dramatically year after year after year, and you get more for your money year after year after year.
Where you're talking about kind of the pricing power coming down, because Warren Buffett probably infamously talked about how if you need to have a prayer meeting before raising prices, then you maybe don't have a fantastic business. But how does it kind of work in the IT world related to that?
I am trained as an economist. As I said to you, that's my life. So what I would tell you is that elasticity of demand is alive and well, and if people can reduce prices, things that were not feasible to do become feasible to do, and that's what you see in IT. Uh, the All your listeners have probably heard about the cloud, right?
Right.
What do you think the biggest benefit of the cloud is? It's cheap. It's very cheap, and it comes down in price every year, every year. And yet AWS is still growing at 45%, and Microsoft Azure is growing at, 85%? It's a pretty basic thing. If I can do something for $1 that used to cost $2 to do, the odds are I'm going to have more than twice the demand for it. That's what's going on. Really is. It's not that. It's not much more complicated than that. The elasticity of demand is very high. I get back again to digital transformation. It's very expensive to do a digital transformation. It's not just the software you need, but it's the people process. The people are all the time looking to figure out how to diminish the cost of a digital transformation. In the last 2-3 years, something called low code and no code has become a paradigm. That basically means you no longer have to know a computer language to implement some of these digital transformations. That's one of the reasons why the demand for these digital transformations has shot up, because it's much easier to do. And when I say it's much easier to do, it costs much less than it used to cost. That's really what's happened. And that will continue to happen, I believe. I mean, artificial intelligence. I first studied multiple linear regression when I was at Penn. You do it in 1963 or 4. God knows how difficult it was to do. It's exhausting. Punch cards, overnight runs, all that kind of stuff. Now you take a company like Alteryx that has made it AI accessible to what are called citizen data scientists, people who really are not trained in to be data science. They're not degree holders, but they can use what Alteryx has. That's why Alteryx is growing at 59%, is because they've democratized access to information so that everybody can get a hold of it and do something with it. And queries that were not really economic to ask a few years ago, all of a sudden I can weigh alternatives and make better decisions. If you could do that, wouldn't you do that if it didn't cost too much or wasn't too troublesome? Of course you would do it. So basically what you're seeing is price elasticity work its magic.
But I don't want to take up too much of your time, Bert, but I think it would be a fun way to kind of end it for you to, I mean, if you're comfortable with it, to just talk about a company that you think, it could be one of the ones that you brought up, but just one of the ones in 2019 that you think looks pretty good.
In my service, I have a model portfolio, but regardless of that, Zscaler is a great company. Alteryx is a great company. Nutanix is a great company. Trade Desk, as we have talked about, is a great company. Atlassian. Which one should I talk about? Ryan, your choice. Or do you want me to?
How about Nutanix?
So Nutanix is a fascinating case study. It started out as a hardware company, and it basically developed software that facilitated hyperconvergence. But its value add is not, it bought hardware boxes from OEMs. The major value add that Nutanix has is software that runs on everybody else's hardware. So it runs, not only does it run on white boxes, Chinese hardware, Huawei, I believe is how you say it. Runs on IBM, it runs on HP, it runs on Dell. There are 7 different hardware platforms it runs on. This has essentially freed buyers from any kind of vendor lock-in. So they can use Nutanix hyperconverged without paying much attention to whose hardware it's on. It runs the same. And Nutanix has developed something called a hypervisor, which is a way of managing data centers that is a generation in advance of the other major hypervisors that are on the market. And now with Z backup and recovery, until recently, backup and recovery was basically a hardware process. You bought an appliance and you put the appliance in a mountain or in some hardened site remote from your data. And then if, God forbid, you had an outage, you would take the data and you'd have to rehydrate it. That's what they call it. I kid you not. Rehydration usually takes about a day. So it's a bad process, bad thing. The Z paradigm is total. It's all software. There's no rehydration. Backup and recovery is basically invisible to a user. I expect in 2019 that we're going to see, let me put it to you this way. Nutanix is still growing north of 50%. I'm not sure how much faster it can grow than 50%, but backup and recovery is a market that is actually larger than hyperconverged. So I would expect that while some people think Nutanix is expensive, I say it's not, because it's got years of 50% growth ahead of it.
But Bert, we don't want to take up too much of your time, but it has been a pleasure to pick your brain about kind of your investment process and how you think about tech companies. You can always check out Bert at Ticker Target Investments. But yeah, I just wanted to thank you so much, Bert.
Thank you, Ryan, for having me as a guest. I appreciate it. Look forward to talking to you.
Thanks again for listening. You can find more information at www.investingcity.org, where you can sign up and subscribe for our email newsletter that goes out every Tuesday and Friday. And you can also follow us on basically every social media platform on the face of the earth. And if you're feeling extra generous, please leave us an iTunes review, as it really helps us out. And with that, have a fantastic day.